If you are over 65 and filed taxes recently, or even skipped filing because you thought you didn't owe anything, you need to stop what you're doing right now and watch this entire video, because what we're about to share with you could put thousands of dollars back in your pocket. Money that the IRS may already have waiting for you, but simply hasn't sent because nobody told you to ask for it. We're talking about 5 hidden refunds and credits that most seniors and retirees completely miss every single year. And when you add them all up, the total can easily exceed $4,800 or more depending on your situation. This is not a scam, this is not clickbait, and this is not some complicated loophole that requires a team of lawyers. These are real, legitimate IRS provisions written specifically for people over the age of 65. And the majority of retirees never claim a single one of them. Every year, the IRS processes billions of dollars in unclaimed refunds and credits that simply go undelivered because taxpayers either didn't know they qualified, filed incorrectly, or didn't file at all. In fact, the IRS has reported that hundreds of thousands of seniors leave money on the table each tax season simply due to lack of awareness. And here's the part that stings. There are deadlines. If you miss the window to claim what's yours, that money doesn't get saved for you. Let's start with the first hidden refund. And this one is one that almost every senior qualifies for, but far too many overlook. It's called the largest standard deduction for seniors. Once you turn 65, the IRS automatically allows you to claim a higher standard deduction than younger taxpayers. For the 2024 tax year, a single filer over 65 can claim a standard deduction of $15,700 instead of the regular $14,600. If you're married and both spouses are over 65, that number jumps even higher. Now, this might sound like basic information, but here's the problem. Millions of seniors either don't realize they qualify for the higher amount, or their tax preparer forgets to apply it, or they're filing with outdated software that doesn't automatically adjust for age. If you didn't get this deduction in previous years, you may be able to file an amended return and claim what you missed. An amended return, which is filed using IRS Form 1040-X, can go back up to 3 years. That means if you were overcharged in 2022 or 2023, you may still have time to fix it and get that money back. Don't assume your return was done correctly. Now here's where it starts getting really interesting, because the second hidden refund involves Social Security. And I know a lot of you watching right now receive Social Security benefits and may not realize that a portion of those benefits could actually be tax-free. And you may have been paying taxes on income you never should have been taxed on in the first place. Here's how it works. The IRS uses what's called your combined income to determine how much of your Social Security is taxable. Combined income is your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. If that total falls below $25,000 for a single filer or $32,000 for a married couple filing jointly, then none of your Social Security is taxable. If it falls between $25,000 and $34,000 for singles, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. Now the key word there is up to. Many seniors end up in a grey zone where their income shifts from year to year. And if their income dropped due to a job change, a spouse passing away, or reduced investment income, they may have overpaid taxes on their Social Security without realising it. If that sounds like your situation, an amended return could recover that money. Seniors have received refunds of $600, $900, even over $1,000 simply by recalculating how much of their Social Security should have been taxed. And speaking of getting money back, if you're finding this information helpful so far, please take a second right now to hit that like button and subscribe to this channel. We publish updates like this regularly: IRS changes, Social Security rules, Medicare updates, retirement benefits. And every video is designed specifically for seniors and retirees who want to stay informed and protect their financial future. Subscribing is free, and it ensures you never miss an important update that could affect your money. The third hidden refund is the credit for the elderly or the disabled. And this is perhaps the most underused tax credit in the entire IRS code when it comes to senior taxpayers. A tax credit is different from a deduction. A credit directly reduces the amount of tax you owe dollar for dollar, which makes it incredibly powerful. This particular credit is available to US citizens or residents who are either 65 or older, or who retired on permanent and total disability and receive taxable disability income. The credit can be worth between $3,750 and $7,500 depending on your filing status and income. However, and this is the critical part, the income limits are quite strict. To qualify, your adjusted gross income must be below $17,500 if you're single, below $20,000 if you're married filing jointly and only one spouse qualifies, or below $25,000 if you're married filing jointly and both spouses qualify. In addition, your non-taxable Social Security, pension and annuity income must fall within certain limits. Now, because of these income thresholds, this credit primarily benefits lower income retirees. But here's what's important. Many seniors who are living primarily on Social Security and a small pension or small savings distributions may actually fall within these limits and not even know it. This credit is claimed on Schedule R, which you attach to your Form 1040. If you've never heard of Schedule R, that's exactly the problem. Most tax software doesn't prominently feature it, and many part-time tax preparers skip right past it. If you qualify, this credit can wipe out hundreds or even thousands of dollars in tax liability, and in some cases, if you haven't been claiming it, you may be able to recover that money by going back and amending prior returns. The fourth hidden refund is something that has caught a lot of seniors off guard in recent years, and it involves retirement account withdrawals and the rules around what's called a Qualified Charitable Distribution, or QCD. If you are 70 and a half or older and you have a traditional IRA, the IRS requires you to take what are called Required Minimum Distributions, or RMDs, every year. The problem is that RMDs are counted as ordinary taxable income, which can push seniors into a higher tax bracket, cause more of their Social Security to become taxable, and even trigger higher Medicare Part B premiums. But here's what most seniors don't know. If you donate directly from your IRA to a qualifying charity, up to $105,000 per year in 2024, that distribution is excluded from your taxable income entirely. You don't get a deduction for it. Instead, you never have to claim the income in the first place. For seniors who are charitably inclined, this is an enormous tax-saving strategy. But the hidden refund angle comes in when seniors have already taken their RMD as cash and then donated to charity separately. In that case, they may be able to go back and evaluate whether they structured things in the most tax-efficient way. And for future years, switching to a QCD strategy could result in hundreds or even thousands of dollars in annual tax savings. Some seniors have found that making this change effectively created the equivalent of a $1,200 to $2,000 annual refund in reduced taxes. This is not money the IRS sends you in a check. It's money you never hand over in the first place, which is even better. Now we've arrived at the fifth hidden refund, the one I promised you at the beginning. And this one genuinely surprises most seniors when they hear it. It's called the Recovery Rebate Credit. And while you might think the era of stimulus payments is behind us, the IRS has been quietly notifying taxpayers in recent months that there is still unclaimed recovery rebate credit money sitting in IRS accounts for people who either didn't receive their full stimulus payments during the COVID years or who didn't file a return to claim them. In late 2024 and into 2025, the IRS announced that it was issuing automatic payments of up to $1,400 to approximately 1 million taxpayers who were eligible for the 2021 Recovery Rebate Credit, but never claimed it. The IRS said these payments would go out without taxpayers needing to file anything, but that only applies to a specific group. For others, particularly seniors who didn't file a 2021 tax return because they assumed their income was too low to require filing, the credit may still be unclaimed and waiting. The deadline to file a 2021 return and claim this credit was April 15th, 2025. If you missed that deadline, that specific opportunity has closed, which is exactly why staying informed matters so much. However, the broader lesson here is that not filing a return because you think you don't owe taxes is one of the most expensive mistakes a retiree can make. Let's take a moment to bring this all together, because when you look at all 5 of these opportunities, the enhanced standard deduction, the reduced taxation of Social Security benefits, the credit for the elderly or disabled, the qualified charitable distribution strategy, and the recovery rebate credit. The combined financial impact for an eligible senior could very easily exceed $4,800 or more across 1 or 2 tax years. Some retirees who have gone back and corrected multiple missed items have received total refunds or tax reductions in the range of $3,000 to $6,000 or higher. And yet, year after year, this money goes unclaimed because no one explained it in plain language. First, pull out your tax returns from the last 3 years, 2021, 2022, and 2023. And look at them carefully. Check whether the standard deduction reflects your age. Check whether Schedule R was included if you're a lower income senior. Check whether your Social Security was taxed correctly based on your combined income. Look at any charitable giving you did and whether a QCD would have been more advantageous. And if you didn't file a return in 2021, speak with a tax professional immediately to find out whether there is still any path to recovering what you may have been owed. Second, consider working with an enrolled agent or a CPA who specializes in senior tax issues. These professionals are familiar with all of these provisions and can review your prior returns for errors at a relatively modest cost. And the refund they find may be many times what you pay them. Third, be very careful about who prepares your taxes. Many storefront tax preparation services during peak season are staffed by people with minimal training, and they frequently miss credits and deductions that apply specifically to seniors. Ask your preparer directly whether they've checked your eligibility for Schedule R and whether they've reviewed the taxability of your Social Security income. The IRS is not going to call you and tell you that you overpaid. The government is not going to send you a letter explaining all the credits you didn't claim. That's not how the system works. The responsibility falls entirely on you, the taxpayer, to know your rights and claim what's yours. That's why content like this matters, and that's why staying informed is not just a good idea. For retirees on fixed incomes, it can be the difference between a comfortable month and a stressful one. If you found this video valuable, please do not keep it to yourself. Share it with a spouse, a sibling, a friend, a neighbour, anyone over 65 who files taxes and might be leaving money on the table right now. And if you haven't already, subscribe to this channel and turn on notifications so you never miss an update. We are here every week with the latest IRS changes, Social Security updates, Medicare rules, and retirement financial news explained in plain, simple language designed for real people. Not accountants,